the lurking green-eyed monster of inflation. Is the yield curve inversion signaling more than a recession coming? Hello, this is Chart GPT today. You know, a lot of talk on the financial markets about the inverted yield curve. It's probably inverted as much as it's been. We'll see this coming up shortly in the charts since the early 1980s. First of all, what is a inverted yield curve? This is when the short end is higher than the long end. So that's called a negative inversion there. It suggests that most people think it's an indicator of future economic recession or even worse coming. So the question a lot of people have is a recession coming? Other people think it's a soft landing. So let's get into the charts and see what this might look like. Here's a very, very long-term chart in terms of yield inversion. This is the 2-year credit versus the 2-year credit on the U.S. Treasuries. And you can see here we're quite negative. You can see this, and there's links there you can get to see other credit spreads, but this is one a lot of people look at. And it's the lowest it's been since the 1980s. You have to go back to the 1929 to see what that looks like in terms of other incidents that happened in the past. Now, what's going on with the Fed is that they're trying to fight inflation with higher interest rates. So when inflation is higher, typically the Fed raises rates, and the inverse is also true. Right now, they're trying to fight inflation. As we know, we've had a 40-year high inflation rate, so they've been raising the interest rates. But take a look at this very long-term chart, and this is what we call normal versus real interest rates and inflation. So the red is the inflation rate, the black is the nominal interest rate, and blue line is the real interest rate, and that's obviously the subtraction between the inflation and the nominal rate to give you what the real cost of money is. So one of the things we try to do is look at what today's phenomenon and go back in history to see what has happened in the past. So discounting a little bit of what happened in the 1929s, because it was because of an extreme event, and monetary policy thinking was very different back then, as well as the World War II period. Probably the most comparable thing that we see today was what happened in the late 1970s, and you can see here that it peaked around the 1980s. That's when Paul Volcker came in and smashed inflation with the high interest rates, which is what we were discussing before. Are we experiencing the same thing? What I want to draw your attention to is that the lead up to the end of the 1970s, there's actually 3 waves of inflation. There's the first wave, second wave, and the third wave. Each wave gets successively higher until really strong action has been taken by the Fed. Now, so we try to look at that and look at what we see today. And on this next chart, I kind of separate out the period of the 1970s, 80s, and today, and try to project forward what that might mean. Look at what these 3 waves look like. Here on this next chart, we can see on the top, we see these 3 waves as it successively got higher. You first get the initial wave, then back off. Next. Now the question is, where are we at today? Maybe we've had an initial wave prior, pre-COVID, and then we had the COVID wave. And so the point is, whether we're in the second or third wave could be of debate, but anyway, the third wave is obviously the largest, and that's probably what we're seeing. So a little pullback from the recent 2022 inflation, pullback, and then continuation of the inflation rate, and of course the nominal and the real interest rates would follow, and then before something happens to whether it's a recession or whether it's massive change in Fed policy, what's going to happen here. So looking at beginning of this next wave, we've made this prediction before. You've probably seen this before on our channel here. Is that with rates around a little over 5.25, they could come down to make that next trough in this red line here on the left, and then begin to rise after the U.S. elections. Many times, whether you believe it or not, the Fed is not as independent as they may say they have, and they tend to follow what the politics of the time is. So what this is suggesting is that, again, if this is only the first wave in 2022, this could even go higher. So that's a bit of a debate. But the point is, either way, whether this is second or third wave, we're looking at much higher interest rates probably after the 2025, if history is any prediction of the future. Now, we'd ask the AI, what are the main reasons for the yield inversion, what it means for the future, and take a look at the AI on that. And also, you can answer our online poll. Is inflation dead, or was it going to come back in a second or third wave to even higher rates than before? Take that online poll and give us your thoughts on that. Don't forget to subscribe.